So chapter 21, what is chapter 21 all about? What happens? We're going to do a couple of things. We're going to introduce you to the idea of GDP. So number one, we're going to define GDP. We're going to get introduced to this thing called the circular flow model, and what that is going to show us is that we can measure GDP in two different ways. And because we can measure it in two different ways, we're going to explain why GDP is both equal to aggregate expenditure and aggregate income. Okay, so our circular flow, that's number 3. 2, circular flow model, aggregate expenditure equals aggregate income. The symbols for aggregate expenditure, AE, aggregate income, Y, both of these are measures of GDP. So number 1, define GDP. Number 2, show a circular flow model. Then number 3, show that there are in fact 2 methods that are used to calculate GDP. These models are, these approaches are the income approach and the expenditure approach. Okay, so 2 different ways of measuring GDP. As I said, income or expenditure. Income approach, expenditure approach. We're going to explain that there is a difference between something called nominal GDP and real GDP. Nominal, real. We'll talk about why those are different. Then we're going to look at how real GDP is used to measure economic growth. And then finally, explain the limitations of using real GDP as a measure of how well our economy is doing. Okay? So we can use GDP to measure growth, but measuring growth is not necessarily a good measure of, our economic well-being. We'll talk more about what that means. We probably won't finish today, and that's fine. We've got tomorrow as well. So let's begin. What is GDP? GDP is gross domestic product. Okay? Gross domestic product. And if we just look at the definition, we can talk about it in a moment. What is gross domestic product? It is the market value. Number 1, the market value of the final goods and services. Number 2, final goods and services produced within a country. So final goods and services produced within a country in a given period of time. Okay? So there are 4 parts to that definition. First of all, gross, basically everything. So final goods and services. Gross, we're talking about all the stuff produced. Product, stuff produced. Domestic, within our borders. Domestic versus international. International would be the opposite of domestic. Domestic means everything inside South Africa. So gross domestic product, everything produced in the economy. When we say the market value, what do we mean? Well, to measure total production, we must add together the production of all the items that are produced. Okay? So GDP values items at their market values, which is to say the prices at which items are actually traded. So the actual price at which things are sold is the market value. So we'll look at an example in a moment, but just to kind of give you a heads up, let's say we had an economy, and in our economy we only produced apples and something more exciting than apples. Sorry, what? Strawberries. Okay, cool. Let's go with that. So our economy produces apples and strawberries, and say that in our economy we produce 10 apples because we're pretty small, and we produce 30 strawberries, and those apples get sold at, I don't know, 5 Rand an apple, and the strawberries at 30 strawberries, what's that, like 1 punnet of strawberries? It's not very exciting. How much would that sell for? I don't know, 60 Rand, let's say. Wait, sorry. 2 Rand per strawberry, so 60 Rand for the punnet. So our apples would be, what, 50 Rand worth of apples sold? That looks dreadful, sorry. 50 Rands worth of apples sold, and strawberries, 60 Rands worth of strawberries sold. What was the total market value of the output, or the amount of stuff produced in our economy? right? That's what we mean. Market value of all the goods and services sold within a country, within a given period of time. We'll get to that in a moment. When we say all final goods and services, the word final there, that's important. Okay? Final goods and services. A final good or service is an item that is bought by its final user during a specific time period. Okay, what do we mean by that? Well, if we take our economy of apples and strawberries, and let's assume that, okay, now our economy is going to be a little bit more advanced. It's not only going to produce apples and strawberries, it's also going to produce apple strawberry milkshakes, smoothies, apple strawberry smoothies, right? Okay, so we can mix them together and we make a smoothie. Then you can imagine we might produce apples equal to 50, right? Is that what we produced last time? Sorry, apples equal to 10. So we produce 10 apples, and let's say that of those 10 apples, 5 of them get eaten by people. Okay? Just straight up. 3 of them go into smoothies. Okay? And those smoothies get sold. In other words, people buy those smoothies and they are consumed. Another 2 of those apples go into smoothies that don't actually get sold. Okay? So there's 2 smoothies that we're going to sell next period. Okay? So 2 into smoothies that are not sold. Oops. Smoothies not sold. Okay? When we want to understand the GDP for our economy, right? We want to include the fact that 10 apples have been made, right? But 10 apples weren't sold as 10 apples, right? So when we do our accounting now for our GDP, well, there's only 5 apples that actually got sold as apples, right? So for our final goods and services in our GDP, the number of apples sold will only be 5, even though we produced 10, right? Why are we only including 5 apples? Well, because in our GDP we would also include 3 smoothies that were sold. And when we include the value of the 3 smoothies that were sold, involved in that selling price must be the 3 apples that went into it, right? So in other words, if we sell our smoothies, if an apple costs 5 rand and we've used 3 apples in our smoothies, 15 rands worth of apples went into smoothie production, right? So if we sell our smoothies at 30 rand is the total value of the smoothie. 15 rand of that value was the value of the apples. So when I include 30 rand for a smoothie that was sold, I've already included the value of the apples, right? Okay. So final goods and services, I'm not going to include 10 apples, I'm going to include 5 apples plus 3 smoothies sold, plus I'm going to have smoothies that are in inventory. This will become something called inventory. Okay? And we'll see how inventory goes into measuring into GDP as well. Okay? But those 2 apples that went into inventory won't be considered apples, they will be considered inventory when I measure my GDP. Okay? So final goods and services, it's the item that is bought by the final user. 5 apples get eaten, well, those people eating those apples, those are the final users, because, yeah, that's where the process ends, right? 3 smoothies get eaten, that's where the process ends. Okay? The smoothies that weren't sold, they go into something called inventory. That's where that process has ended at that point in time. Inventory. Final goods differ from intermediate goods. What is an intermediate good? Well, if we look at our example with the apples, those apples that went into smoothie production are intermediate goods. Those apples were not made for the purpose of eating. Those apples were made for the purpose of going into smoothies. They were part of a process. They were intermediate goods within that process. They were not the final goods of that process. Okay? So why do we only include final goods? To avoid double counting. Double counting means adding the value of the intermediate goods and services produced to the value of the final goods and services. We don't want to do that. Okay? Because then we've got an inaccurate indication of what's actually happening in our economy. Okay, so that's the second point. The third point, it's produced within a country. So we're going to talk about the GDP of South Africa. It must be GDP that is produced by South Africa. Okay? The GDP of China is produced by China. The GDP of Tanzania is produced by Tanzania. Okay? And then within a given time period, what we mean is when we calculate GDP, we normally give it with the time, when we calculate GDP, it is for a time period, right? It doesn't have to be a set time period. So we might have something like quarterly GDP. We might have something like annual GDP. We might have daily GDP if we wanted, but we don't really have the data for daily GDP. So quarterly GDP would mean this is the GDP. In other words, this is the gross domestic product. This is the amount of stuff that was produced. Quarterly means in 3 months. Annually means over a full year, 12 months. Okay? So those are the 4 components of our GDP measure. Now what I have done is I've adjusted the order of the slides and swapped them around a little bit just because they didn't make much sense to me. So if you are following in the slides, you're going to have to skip ahead to get to this slide and then come back to the slides that I have skipped. You got it? You got it? Cool. Okay. Great stuff. Okay, first of all, just talking about gross, not like, right? Gross means before subtracting capital depreciation. And the opposite of gross is net, which means after subtracting capital depreciation, which just all sounds horrible. What do we mean? Let's just write it as an equation. Gross GDP, okay? So I'm going to call it GDP G for gross, okay? Means the same as, is equal to GDP net, so GDPN, plus depreciation. So you guys have all done some basic accounting, I'm assuming? Okay, hands up if you haven't done any kind of accounting at all. Okay, that's easy then, cool. You should know something about what we mean by depreciation then. Okay, hands up if you don't know what depreciation is. Okay, perfect. So depreciation means the reduction in the value of stuff. Okay, it's the stuff that gets used up in production. So if I have a machine and my machine has a useful life of 10 years, what that means is after 10 years I expect my machine not to work anymore. Okay? So if I buy my machine today for 100,000 Rand and in 10 years time I cannot use it, it means that cost of that machine, I'm basically using 10,000 Rand of that machine's value every year for 10 years. I've got a cost, 10,000 Rand's worth of machine is kind of getting used up every year as an average. So when we say gross GDP, what we mean is how many things, like including capital machines and stuff, did I produce? Okay? Gross. Net GDP says how many things, if I take my gross GDP, how many things did I produce, including machines, right? Minus the reduction in the value of those machines that got used up because of depreciation. Okay? So I could write this equation in a slightly different way and say GDP gross minus depreciation equals GDP net. Okay. So when we're talking about gross domestic product, what we want to know is how much stuff did we produce regardless of how much stuff we used up in doing that production. When we have GDP net, then we're saying how much did we produce minus the stuff that we used up in producing it, right? Not the stuff, the machinery, the useful life of machinery and factories and things like that. Okay? So just a definitional issue here about what we mean by gross. Okay? So the total amount spent both buying new capital and replacing depreciated capital is called gross investment. The amount by which the value of capital increases is called net investment. Okay? In other words, here's a diagram. We have some amount of capital. What do we mean by capital in economics? Capital means buildings, and it means machines, and it means equipment. Okay? When we talk about capital, the assumption is usually that we do not mean financial capital. Financial capital means things like stocks and bonds and shares and stuff like that. Okay? We're not talking about financial capital. We're just talking about capital in the normal economic sense, which is buildings, machines, equipment. So if I have some value of buildings and machines and equipment, and during a period I use those buildings, machines, and equipment, they will depreciate, right? So their value will go down by a little bit. But if I build new buildings and machines and equipment, then my total amount of capital will increase. Right? Everyone with me? This yellow block is called gross investment. If I take gross investment and I minus depreciation, I will end up with net investment. Right? And you can see the total value of my capital has increased by the value of net investment. Right? Because it went up by this amount, but it went down by this amount. So overall, the net change was this little purple block. Everyone with me? Questions? We're still doing the simple stuff, right? This is simple stuff, right? Okay, cool. Good. Okay, so the total amount spent both buying new capital and replacing depreciated capital is called gross investment. The amount by which the value of capital increases is called net investment, right? So we've seen that as a diagram. Now that we understand what we mean by gross domestic product, let's look at the different components of gross domestic product. This is called the circular flow diagram. This is the diagram that you will see in chapter 21. The diagram that you see in chapter 24 is a little bit more exciting. Okay, there's all these like green lines going on. The one in chapter 21 doesn't have them. This one's more exciting. What is the circular flow showing us? The circular flow diagram is kind of a summary of what's happening in our economy. Okay? In our economy, we are going to talk about different, let's call them players, right? Not like P-L-A-Y-A-S, right? These are just the different agents in our economy. So we have households. Let's call them number one. We have firms. So firms is now the word that we use for businesses. We have the government. And we're going to have the rest of the world. Those are our different components. And they're all going to interact. And if you think this diagram looks kind of confusing, yeah, I suppose you're right. But we're soon going to start modeling this diagram with equations and with graphs. Right? So it's going to get, what, you ain't seen nothing yet, right? Okay. We're going to get there. It's going to be cool. We're going to win. You're going to be tired of winning. Right? Channeling my inner Trump. So our households are going to interact with our firms. So these arrows say that households interact with firms and firms interact with households. Okay? These arrows over here show us that households are going to interact with governments. Governments are going to interact with firms. Okay? Firms are going to interact with other firms. Households are going to interact with the rest of the world. Governments are going to interact with the rest of the world. The rest of the world is going to interact with our firms. Okay? Our circular flow. Let's isolate one component, households. What we're going to show is households earn something called income, which we're going to call Y. Okay? I'm going to add it on this diagram, and don't worry. As I say, everything that we talk about now, we're going to talk about for the rest of the course. Right? So households earn something called income, and we're going to call income Y. Okay? What do firms do with their income? Firms either save their income. Well, let's start here. Firms consume their income. In other words, they spend their income on things. Okay? Or they pay taxes. Okay? Or they save. Okay? Income. Consumption, taxes, or savings. Okay? When they consume, we call this consumption expenditure. What they do is they purchase things through something called the goods market. Okay? So you buy goods and services through the goods market from firms. All that consumption expenditure goes to firms. So any of the income that household spends through consumption goes directly to firms. And that becomes firms' earnings. Right? Okay? Any taxes that come out of your income go to government. What does government do with it? Well, government also uses that money to buy goods and services. Who does it buy those goods and services from? From the firms. The firms are the ones that produce stuff. Okay? So household taxes go to government, becomes government spending. Alternatively, households can save. And if they save, what happens? Well, you save through financial markets. Your savings get directed, guess where they go? To firms. Right? How does it get to firms? Well, what firms do with those savings is they embark on kind of expenditure called investment. So this savings comes all the way around through financial markets to firms. Firms take that saving and they use it as investment, and with investment through goods markets, they buy things from other firms. Okay? So in other words, a farmer that produces carrots will buy a tractor from a firm that produces tractors. Right? And that would be called investment spending. The farmer buying a tractor would be investing. Okay? The household savings through financial markets would essentially be a shareholding in that farm. Okay? So the farmer needs to buy a tractor. The farmer goes to financial markets, borrows money in financial markets, buys a tractor, uses the tractor to produce carrots, sells the carrots in the goods markets, earns money for selling the carrots, pays back the loan. Right? The loan is the household's savings. You with me? Yeah. So household spending, consumption, taxes, or savings. Governments. Governments can purchase goods and services from firms. What kind of goods and services do governments purchase from firms? Well, if they're going to build roads, they will contract with a road construction company. If they're going to build bridges, they contract with a bridge construction company. Right? If they want to produce dairy products, they give money to the Minister of Agriculture in the Northwest Province, who siphons that money off to a specific wedding. And then people get flown in from overseas And then we never see the money again, right? So, government spending also through firms. Alternatively, governments can also borrow. If governments borrow, that's called a deficit. If they get more tax money than what they spend, they end up with something called a surplus. What can they do with that surplus? Well, the same as what a household can do with its surplus income. It can save it. How does a government save surplus income? Through financial markets. It can send any surplus income that it receives, channel it through financial markets, and can either lend it to people who want to borrow from overseas, or can lend it to firms, for firms to invest. Okay? Government does invest in firms. Governments do lend money to other countries, right? And other countries lend money to us as well. So, through financial markets, you can have lending and borrowing from governments, households, firms, or the rest of the world. Through goods markets, you can have households or governments or firms purchasing goods, or you can have the rest of the world coming and purchasing our things. When foreign countries purchase our goods and services, what do we call that? Any idea? What do we call it when we send goods and services somewhere else? Exports. You got it. Okay? So we can export. Alternatively, we can import. Right? That's through goods markets. And of course, what do firms do with all the money that they make from the goods that they sell? What do they do with all that money? They pay salaries. Becomes the income which goes to households. So on this side we have expenditure. Okay? On this side we have income. So our circular flow diagram tells us that on this side we have income. On this side we have expenditure. And the income that is earned will equal the expenditure that happens in the economy, right? So when we want to measure GDP, when we want to know how much stuff has been produced in an economy, we can either look at how much was sold, or we can look at how much income was earned. Okay? So we can measure GDP either by calculating all the income, or we can do it by calculating all the expenditure. Either way, we should end up with the same number. So we've spoken on this slide about all the different players, the households and the firms, government and the rest of the world, and the fact that GDP must equal expenditure, must equal income. Okay? So that little diagram, I'll get you in a second, that little diagram is basically everything that we're going to talk about in this course. Okay? There it is. That was quick. See you in 7 weeks, right? No. What did you want to say? Yeah, it's a good question. The recording of all this activity is not perfect. So our GDP measures are subject to errors. Bear in mind that even if we're bad at recording the things that happen, there are also people that produce stuff that don't want a record of it ever being produced. Right? Could you think of any examples of the kind of people that might want to not be recorded in? Yeah? Yeah? So my tick factory is probably not going to be, recorded within the GDP figures. So yes, GDP is not a perfect measure. And remember what we said at the end of this whole discussion, we're going to talk about problems with measuring GDP, right? Problems with the measure of GDP. So what you've got there, you identified already one of the problems. There was someone who was kind of, I don't know, doing this sort of thing, but I don't know if that means. Did you have a question? No? Okay, cool. Yeah. If you want to stretch or whatever, it is somewhat confusing for me. So, I don't know. Bear that in mind, I guess. So there's our circular flow diagram. That's everything we're going to do, the whole course. Cool. So there's the slide that talks about all those different parts of that diagram. When we talk about the expenditure approach and the income approach to measuring GDP, the expenditure approach means we add up all the things on the expenditure side. So let's just go back to that diagram quickly. All the things on the expenditure side. What kind of expenditure do we have? Household consumption. Household consumption expenditure. Government expenditure. Firm expenditure. Expenditure from the rest of the world. So if we want to measure GDP, we add up all those different expenditure components, we're going to have the value of GDP. If we're using the income approach, where did income go to? Consumption, expenditure, taxes, savings, right? We don't show on here exactly what kind of incomes you earn, but what we'll talk about now is the fact that when you get income, okay, so when we talk about the income approach, you measure GDP by summing up all the different types of income that a firm can be generated within an economy. The two major categories of income approach is what was your compensation of employees? In other words, what was your wages? Okay, wages. And the second is net operating surplus, which basically means firm's profit. So firm's profit will get distributed either stays as retained earnings, or it becomes dividends and goes back to households through dividends, right? At some point it will return back to households, either through profit distribution or through any other mechanism of returning retained earnings, basically. And then wages. The textbook does give you a little bit more of a breakdown. Oh, actually, I've got a slide for it, so don't worry. So here's GDP. This is the diagram from the textbook. If we're looking at the expenditure approach to measuring GDP, what are our components? Consumption, investment, government spending, net exports, and then our total gross domestic product. Okay? So the figures that we have here from 2011 are GDP in South Africa. Consumption expenditure, 1.7 billion. Investment, 6 billion. Yeah, in the last few years, this number's probably decreased a bit as a percentage. I will get the latest figures for you, because that will be fun to see. We have had a bit of a problem over there for one particular reason. And it's a political one. Anyway, it would be nice to see how that's changed. Then you got government spending, and then net exports. So exports minus imports. If it's a minus number, what does that mean? Did we export more than we imported, or did we import more than we exported? We imported more, right? What that means is we bought more stuff from other people than we sold to other people. Okay? So if you can imagine, part of the spending number here will include spending on stuff that we bought from other people, right? So that's why we need to take that out, that spending out, minus M. Okay? And here what ended up happening was we ended up buying more than what we sold to other people. So that's going to be a negative. It's going to decrease our total expenditure number. So our gross domestic product around 3 trillion. How many encounters is that? Yeah. 2. No? Then you have the income approach. Okay? How do we measure GDP? You can see here's our GDP measure. Approximately 3 trillion. same, approximately 3 trillion. Okay? But now we're going to get to that number by adding up a whole bunch of different things. And these are the different kinds of income that we earn. So what do we have? Compensation of employees. So as I say, that's basically wages. Then you can earn interest income, rental income, dividends, proprietor's income. In other words, if you own a business, you don't pay yourself a wage as an employee, you earn an owner's income, a proprietor's income. Okay? Then what happens, once we've got our total, this is net domestic income, okay, so we haven't taken into account depreciation yet. We then get indirect taxes, less subsidies. In other words, add taxes back to that value. So this is an accounting exercise for anyone that loves accounting. Take income, add back taxes, deduct subsidies, add back depreciation, and you're going to get a figure here, 2964. 2964 doesn't quite equal 2941, right? And that comes back to the point you made, because we're not very good at measuring things. So somehow we come to a slight difference in our measurements. Okay? Not everything was captured. Yes? There is a third way. It's quite possible. There is a third way. I can't think of it. It's like, does everyone else know what it is? Is that how it is? Okay. Cool. There's a third method which I can't think of right now. There's a suggestion here about adding different sectors' incomes or what? Outputs? Okay, so there's that suggestion, but that's not what I'm thinking about. There's another one. But I don't know exactly how it works. But yeah, these are the two that we care about. These are the two that you will normally encounter if you look at a country's national statistics. But bear in mind that national statistics are only as good as the data that we produce. So, for example, any data currently being produced by Venezuela, essentially meaningless, because Venezuela is a mess. There's a lot of skepticism about the accuracy of China's data as well. It's not sure whether they produce the most accurate data. There's a suggestion that they may fiddle with their books, basically. Okay. Now we want to understand something that maybe is not immediately obvious, which is that when we want to measure GDP, because we're measuring GDP in terms of prices, if prices are not constant, then if we want to compare the amount of stuff that was produced over time, we're going to have a problem if we just look at the value of the goods and services as measured in terms of their prices. In other words, to give you a concrete example, if I produce 100 units of something, right? I really want some kind of exciting thing. What is an exciting thing to produce? A fidget spinner. I don't know. Is that what people care about? Like, what do people want? What's a cool thing? I'm too old for this. What's a cool thing, you know? Like what? I don't know. Justin Bieber, like hologram cards or something. Sorry? There was a cell phone. Okay, fine. Cell phone, yeah. So 90s. Cool. So let's say we produce 100 cell phones and the price of the cell phones is 1,000 Rand each. Okay? 100 cell phones. This year we produce 100 cell phones that cost 1,000 Rand. What is our GDP? 100 times 1,000, 100,000. Easy, right? The value of the GDP, market value of the GDP, 100,000. Next year, I'm told that, in fact, let's do this. Everyone get out a piece of paper and a pen. So here's the two bits of information we've been told so far. You've produced some amounts of cell phones, and the amount that you produced is 100. 100 cell phones produced. The price at which those cell phones were sold, 1,000 Rand. Those are your two bits of information so far. And it's 2017. That's the third bit of information. The year is 2017. So you can now calculate GDP for 2017. GDP for 2017 is 100,000. Our economy only produces cell phones. Right? So that's it. Our GDP, 100,000. Now fast forward, we're now in 2018 and our GDP is 200,000. Okay? Everyone happy with that? Have we produced more stuff? Is my question to you. No? How do you know? Sorry? What? You were saying something? Okay. That's a word. Where does it? How does it fit in? What are you telling me? So I'm saying it's 200,000 next year. That's what our GDP is. Have we produced more? And are you saying you're not sure? Yes? Yes? Okay. Okay. So you are concerned about inflation. And what that means to you is you're concerned about the fact that if we're selling cell phones, the price of those cell phones might have changed. So when I look at that 200,000, I can't tell whether that number has gone up because I'm producing more stuff or because the price has changed. Is that what you're telling me? Good man. So now I'm going to tell you, okay, previously the price of a cell phone was 1,000. Now the price of a cell phone is 1,500. How many things did we produce? How many cell phones? I'm asking you. What's the number? 133. Is that right? So we've produced 133. Now let me ask you the same question. Have we produced more? In 2018, did we produce more than we did in 2017? How do you know you produced more? Because we compared number 133 to number 100, right? So we look at the quantity that we produced in each period, not the market value that we produced in each period, right? Because when we looked at the market value, there was a problem. We didn't know what happened to get us to that market value. Did we produce a different amount or did the price change? Right? Once we know how much the price changed by, we can take 200,000, we can adjust it for that price change, and then we can figure out how many we produced. That's exactly what you just did on your piece of paper now, right? You said, right, I've got 200,000. I know that my prices changed to 1,500. Take my 200,000. I divide it by that new price to get a quantity. And I can see now that that quantity is higher. Okay? Now, here's what matters. If I now wanted to compare the value of GDP in 2017, which was 100,000, okay? That was 100 units at a price of 1,000 each. If I want to compare the value of GDP in 2018 to the value of GDP in 2017, but I don't want to include any change in prices, what do I need to do? I take the number of goods that were produced in 2018, which is 133, and I multiply it by the price from 2017 so that I can get the value of GDP in 2018 as if it was in 2017, so that I can compare. You get what I'm saying? I can compare them without worrying about the change in price. Does that make sense? So what would my value of GDP be in 2018 if I use 2017 prices? 133,000. Now if I compare 100,000 to 133,000, and I know that across those two numbers prices were constant, right? Has my GDP increased? Yes. Has it increased because I'm producing more stuff? Yes. Therefore, I've had real GDP growth. And the number real there, that real means once I've taken out any change in prices. Okay? So when I go from, using our example, and I'll just tap it, bearing in mind, remember our discussion. So when I go from 100,000 Rand as the value of GDP to 133,000 in our example, that would be real GDP growth, right? When I go from 100,000 to 200,000, what that is called is nominal GDP growth. Now, what does nominal mean? Nominal means I look at the value of GDP in that period at those prices. Okay? So, nominal means I don't adjust for any price changes. Real means I do adjust for price changes. If we have nominal GDP growth, does nominal GDP growth necessarily mean we've had real GDP growth? No, and we can show that directly by saying, well, what happens if in our example, in 2018, prices weren't 1,500 like we said, but instead prices were 2,500? We would have the same value of nominal GDP, but what would our real GDP value be? And I leave you on that question. So, the first thing we'll do tomorrow is we'll say, right, what would the value of real GDP be in 2018 if prices in 2018 were 2,500? Okay? First thing tomorrow.